Firstly, because I found it very, very complex and exceedingly interesting. Yeah. And what struck me was the quality of personnel in the industry. The CEOs, the chairman, the various senior managers, CFOs, and all, very bright people. So those were my first impressions, that it is a complex industry and full of very bright people. It took me a while to understand that industry. So initially for almost a year, I was largely learning and listening really, to figure out what this whole thing was.
Okay.
And it's only then that I started figuring out the contours of insurance industry. I mean, just as well, because by then I could understand what it was all about.
Okay.
You know? So yes, in a sense that it is right. In the sense that our understanding of these products were quickened by the Sebi issue, without any doubt.
Really?
Oh yeah. Two things happened at that time. Apart from the Sebi issue of show cause notice and so on, what really happened then was there were a whole lot of articles in the newspapers from different writers, different perspectives about what is wrong with the insurance products. See? So, Sebi was the point of departure to understand all of this. But I think even for the newspaper world, it was the Sebi IRDA issue which really propelled them to write a lot about insurance, about the nature of the products and so forth. And yes, the two happened at about the same time. It gave us a much greater insight into the practices being followed by insurance companies, the design of products, the downsides of it, and so on. Yeah. This is the nature of regulations. The nature of regulation is you do it like that. In other words, let's say there's a flexibility there, and you keep jiggling it around till you get a right fit. You see, the big shock which came was the fact that you could really that the regulator would mandate the boundaries within which a product would be designed. That was the, let's say, awakening to the industry. Was really, let us say, so clearly focused on policyholder welfare as he ought to have been.
Okay.
It took some time to really figure it out.
Oh, okay. So,
I mean, for instance, these products are there all over the world. So you may ask, how come it is good all over the world, it's bad here?
And why is that, sir? Why is
Exactly.
it
If you go into the net and if you type a product called variable insurance product, you'll get a lot of responses from the web. If you type the first one,
variable, highest in AV?
not highest NAP, I'm talking about variable insurance product. And if you type the first Googling, headline which you're going to get, I was shocked when I read that. That article says variable insurance products have been designed to sucker investors. That's his first line. So I would say that there's a lot going on in the world of insurance products, and regulators the world over are very, very chary of regulating products or product design. And they normally have two reasons for doing that. One is they say it stifles innovation, correct? And it doesn't allow free market play. But if you go deeper, I think the reasons are much deeper than that. I think there's a philosophical problem. I think regulators are probably closer to the industry than they ought to be. And it's only very recently, even in the IAIS, that I could finally convince them that they need to look at, the IAIS needs to look at product design. And that was something which they agreed only a few months ago. So it's still, they have to do a lot of work on it, but at least we could get it onto the agenda. That I could get it onto the agenda, product design. And that was something which they agreed only a few months ago. So still, they have to do a lot of work on it. But at least we could get it onto the agenda. That I could get it onto the agenda, product design. I think it's got to do with the attitude of the managers of the life insurance companies. It has to change. Several of them are bankers and they don't really understand insurance.
Okay.
You know? And I think the shareholders also don't understand what they really are in for. See, insurance industry is by its nature a long-term business. For the first 10 years of its life, the investor goes on investing. That's all he does.
That's right.
It's designed like that. Not that it's designed like that, I'm saying the nature of this business is like that. So if you're going to see returns on an insurance industry, you've got to be patient and wait at least 15, 20 years. So unless, but I think that some of the investors anyway, they didn't have that appreciation. In fact, to be quite frank, when the industry started in 2000 and all that, you see, in the non-life side, most of the people in the non-life industry were people who have always been in non-life industry. That is, they got them no doubt from the public sector undertakings and so forth. But in the life side, they did get a few from the LIC. But the bulk of the management were bankers, really. That is India's financial sector. That's where you had people trained in finance. Might not be in insurance, but at least they had an understanding of finance. But I think they had no understanding of insurance. So anecdotally, there are several cases where the chief executive of the company told his board that no problem, in 3 years we'll be bigger than LIC, like that. So they had no idea what they were doing, really. It's only now they're getting to understand what this business is all about. And here, fundamentally, the business is the long term. That's it. The problem entirely lay with the companies. They would define the product so poorly. So most of the time, the office and the company were going on exchanging notes, what this means and what that means. And sometimes it was so gross, the companies didn't have any idea of the product they were filing.
Really?
Yeah. And several times, for instance, in this office, the actuary would come and then he'll say, hang on, these questions are all very fine, you better talk to this guy. He knows. He didn't know. I checked. Whoever that guy was. See? So one of the reasons why I wanted to come out with these guidelines on products was also this. That there should be a clear statement as to what is it we don't want to see in products. What is it we want to see in them? At least if those two lines are clear, the insurers won't be wasting our time and their time proposing various things which won't meet the cut. And product delay and all that, I'm quite astonished because most of these companies have joint venture partners who are familiar and who operate around the world.
Right.
You should ask them, what do their joint ventures find? Product clearance in, say, Australia or UK or any of these countries, how long does it take?
Okay.
In Australia, I know it takes at least a year.
Really?
So this business that, where I got to find a product and immediately I got to get it cleared, it makes little sense. I mean, one should ask oneself, what is this?
And why so many
Why are
products?
you going on churning your products like that?
That's right.
So I think, the industry also got it wrong. I think, they wanted more products. Not because the product really is much different from the previous product.
Top line sale, basically.
It enables that churn. This whole business of commissions which you're talking about. different cultures and different jurisdictions have different systems. For instance, if you take Germany, commissions are back-ended, right?
Yeah.
If you take Hong Kong, commissions are even. Every year is the same, right? In India, it's front-loaded. It's been front-loaded right from 1830 when insurance started in India. So it's going to be enormously difficult to change it. And you see, there's no point in changing it for change's sake. If you talk to the German regulator, he'll give 150 reasons why it shouldn't be back-ended. So it's a question of everybody believes the grass is greener there. But our understanding of insurance commissions also is not correct.
Okay.
See, how it goes is,
it?
if you have got, it's 35% for the first year, then it drops to 7.5% for the second 2 years, then it drops to 5%. This is how it is. Nobody says you got to pay this amount. In fact, they don't.
Sure.
They don't pay this amount in the first year. The average commission which they pay is around something around, if this is 35, it's around a year. It's about 17%. So what I mean to say is that you see, you look at it like this, supposing over the life of the product, this is the total commission which you can give. The question is, how are you going to use this? You can, for instance, you give a baseline premium here, commission here, and this is only an incentive, depending on whether you manage to push this, finish the first 2 years, get on to fourth year, fifth year.
Yeah.
So you know, it's a question of really, what is the maximum you can pay? The pattern of payment, the maximum you can pay in a given year is limited by this, by the act. But a flow you can manage, depending on what kind of management practices you would wish to introduce.
Okay,
So what we are saying, even in this persistence in India of policies is abominable.
That's right.
And you can't have an insurance industry based on that. You can't have an insurance industry which is based, let us say, supposing you have only a single premium industry. Everybody pays only one premium and that's it. You can't have a life insurance industry.
That is right.
You may work some kind of general insurance industry, but it cannot be the kind of industry we want. Life insurance depends on a steady flow of income, which is how you meet the shocks which take place.
That is right.
The randomization of shocks which occurs are met only by the smooth flow of your income, of the premium flow. So if that is not there, the whole model fails.